Good morning, everyone. Thank you for joining us. It is Tuesday, January 26th, and we here at Harvested Financial are looking at the markets. So thanks so much for getting into it. Before I jump into our content today, I want to remind everyone that all the information, commentary, and opinions expressed on this or other website, on any social media platforms, or in any media format reflects the personal opinions, viewpoints, and interpretations of the employees providing such comments and are not to be considered a description or offer of advisory services by Harvested Financial. The opinions expressed are for general informational purposes only and not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide education about the financial industry and not meant to convey investment advice, performance data, or any specific recommendation to buy or sell securities. Harvested Financial employs multiple methods of analysis and security selection to create our client portfolios, which are not discussed in their entirety here. All investments carry the risk of loss, and users should discuss any decisions with their financial advisor. Past performance is not a guarantee of future results. Boom. It is Tuesday, January 26th, like I said, and we are looking at the markets. So I am not going to be talking about GameStop here. That is absolutely nuts. You should check out our Twitter. We're going to go into some of the details there. Absolutely banana situation. The options trading is on a whole different level. But what we are going to look at is some other names that do have some interesting things going on, and it presents a similar type of situation, though not necessarily at the same extreme. But overall, looking at the markets today, how are we doing? Well, SPY is drifting up 83 cents. It's about 21 basis points. We have IWM up 58 cents. That's also about 27 basis points. And we have the Qs up 33 cents, only about 10 basis points. So light rally in the markets this morning today. But the name that we are going to be looking at today for our Collar Tuesday is Jumia Technologies. So the ticker here is JMIA. And I'm going to go ahead and pull up my screen again so that you can see what's going on in Jumia. So Jumia is particularly interesting because it's got one of these crazy call skews. So that's something that I've mentioned before here, talking about when the upside calls get bid higher than the downside puts. So typically the way we like to look at skew is that the downside is going to be significantly higher than the upside. So, we typically see a skew chart that looks like this, where, our downside, the demand for puts and the demands for insurance hedging raises the price of the downside. Volatility tends to get higher as stock market goes down. So we typically see that put skew is the standard sort of skew structure that we see in a equity name. However, Jumia has been seeing some pretty interesting things going on. And there's been a lot of action buying some of these upside calls. And so I'm looking at the area along the curve here, a little bit to the right of where stock is trading right now. So this whole area right here, we don't normally see that. We don't normally see the 65 to 70, 75 names. We don't normally see them trading that much higher than these at the monies here. That's a really interesting situation and presents an interesting opportunity for us to potentially buy downside a little bit cheaper than we typically can and sell upside against that. So in the spirit of a collar strategy, we are going to think, not just about a traditional collar right here, because we have seen some explosion. And actually, let me pull up the chart to talk about why I don't necessarily want to do the standard collar strategy here. So looking at the way this stock has just gone, well, we've gone completely vertical since November. So stock was trading around $10 in October right here, up to 15 in November, and we are all the way up at 60 right now. So stock just has skyrocketed. And in many ways, I think that's probably where some of this bid in the call skew is coming from, that people are seeing this continued motion. They're betting on further upside. And in many ways, the sellers of that premium, whether it's a dealer or whether it's another customer counterparty, is going to want to sell those options relatively richly just because they have seen such convexity and shot to the upside. So that's why we're going for a slingshot trade, because we want to protect our downside. We've obviously seen some pretty elevated gains here, but this has potential to move. And with the standard collar, we sell a call to buy a put, and you sort of have that equal exposure that for every tick up, you are covered, and for every tick down, you're covered. The long put short call combination completely neutralizes your stock position. If we don't necessarily want to totally neutralize our stock position, we have this slingshot opportunity to do something that's a little bit different here. So I'm going to do a sort of multi-month slingshot that I'm going to demonstrate here in Jumia. And I'm going to do that by going first. So recall we're trading right around 60 right now. Stock's up about a buck today. But if I go for these 55 puts in Feb, so I'm going out a little over 3 weeks to that serial Feb expiration. And I want to protect myself below 55. So obviously, we've seen this big run up, a drop of more than is about an 8% drop. So, we're protected beyond an 8% drop. And that's going to cost us, midpoint on this trade is about 590. These option markets are a little bit wider than we're used to seeing. They're definitely wider than some of the benchmark names that we like to talk about. But, seeing a 40, 50 cent wide market makes you really need to navigate execution quality very deftly and really kind of massage your order here so that you're not giving up too much of your potential edge in that spread. So one of the things that Harvested Financial loves doing is managing execution quality and driving that price execution, bringing that right back to our clients' accounts. Every penny we save is a dollar that you earn. So buying this put for around 590, hopefully. That means we need to finance this over the course of the next 3 weeks. A little over 3 weeks, I should say. So the next expiration that they have listed, they have these weeklies, is this Jan 29. I'm not going to go for the Jan 29. It's still a little bit soon. We still only have about 3 days left in that expiration. So I'm going to think about how to split this up over the following 3 expirations. So I have a Feb 5, I have a Feb 12, and I have a Feb 19, all to monetize this put that I bought in that Feb 19 expo. So 590, how do I get $5.90 back from exchanging upside? So one of the objectives here with collars typically tends to be executing them for around zero cost or as close to zero cost as possible. So getting 590 or about $6 maybe over 3 different weeks, we want to collect a little less than $2 on every single trade that we put on. So I'm going to look to find a call spread that I can trade for collecting around $2 in this first Feb 5 expiration. So a couple different options. Well, I can sell away my immediate upside. So I can sell this 61 call at around $7, and I'm going to look to buy a call back for around $5. So that would be the 65 call. So I'm going to collect around $2 on this trade. Maybe not, it's going to be a little bit less than that. But selling that 61, 65, alternatively, if you really want to make sure that you're offset from a cash flow perspective, you could sell the 60 and collect a little bit more, about 70 cents more on that trade. So, a lot of different kind of nuance there, but keeping it simple, 60, 65, max loss on that would be $5 minus the amount that you would collect. So, collecting a little under $2, that's where you would see this potential loss on this. But remember, we're long stock against it. So really what this short call spread is doing is not necessarily giving us a max loss of 500 because we are covered on the stock against it. What it is giving is it's just neutralizing us during this zone. So we're not going to participate in gains between 60 and 65. But above 65, we bought that 65 call back. So our short call is no longer counteracting our long stock position 1-for-1. We have neutralized our call and we are going to participate in upside above $65. So that's that slingshot action to the trade. Another alternative, if you don't want to give up the immediate upside in that 60 to 65 range, is find another way to get $2 here. So another way to get $2 is find a different set of a different call spread that's going to net you around $2. Maybe you care about a little bit more near upside. So maybe you do want that to participate in that 60 to 65 before giving away your meat of upside. So if I sell the 65 call, collect around 520, that means I need to find an option a little over $3 to buy back against that. So if I give up the 65-75 call spread, midpoint on this trade is a little over 215. So if I can get this trade off for collecting around $2, I'm in a good position. I've given up my 65 to 75 upside. So that's a $10 vertical. So you're giving up a wider vertical. We were only giving up a $5 vertical before. With this higher strike one, we're giving up a $10 vertical, but we do get the first $5. So that's an interesting debate that every investor should be thinking about is where do you want to give up your upside along the curve? And kind of the beauty of this slingshot trade is you can select where you want to protect your downside. In this case, we chose the 55 level out in February. And financing that in a couple different ways. So do you want the first $5 of gains here, or do you want the gains above those first $5? Really up to every investor to make that sort of decision about how to handle the equity position that they might be doing the slingshot trade around. So slingshot is a really interesting flavor of a collar. I really like how it still allows an investor to participate in the upside gains, because you're not selling away all of it with that short call, but you're actually defining a specific range with that call spread under which you will not participate, because you want that slingshot action on the upside. So plenty of interesting names, especially when we see this call skew like that in Jumia, that we want to sell that expensive call premium. And in many ways, that expensive call premium might be there for a reason. We have seen the stock continue to jump. So if that does continue to participate, the slingshot gives you that combination of downside protection while still staying exposed to the convexity potential of a name like this. So great stuff here with a trade like this in Jumia. The slingshot's an incredibly powerful stock management tool. Options are incredibly powerful tools overall for surgically tailoring your portfolio and managing exactly how you want that equity exposure to look, and giving you a combination of both protection and income generation potential. So at Harvested Financial, we manage strategies like this every day. But mash the subscribe button and you will be able to follow along with the Daily Bread every morning, where we're talking about different constructions of strategies while we're going out and executing those for our clients every day. You can also follow along on Twitter at harvested_DAFE, because derivatives are for everyone. And of course, tune in here. Like I said, hit the subscribe button. There's lots of great stuff out there. We're always trying to find interesting option strategies to help investors generate income, protect their downside, and manage their stock positions. So